Welcome back to the Deep Dive. Really glad you're joining us because today we've got a unique challenge set by you. You've given us sources that are, well, let's just say exceptionally diverse. It's actually a great snapshot of the kind of varied info you might be juggling yourself.
Yeah, definitely. We have two completely different beasts today. One's really about, human connection, conversation, and the other, a deep dive into corporate finance.
Exactly. And our mission, yours and ours, is to show how you can navigate these seemingly unconnected pieces of information. How you pull out those surprising nuggets of knowledge. So first, we'll unpack a guide to podcast interview questions. Think of it as a blueprint for sparking, engaging talks. Then, we're making a hard pivot. We'll look closely at the 2000 letter to shareholders from Wesco Financial Corporation.
Right, a real peek into corporate finance, how subsidiaries were doing back then, over 20 years ago now.
It's about seeing how these different kinds of documents, these different forms, reveal, well, different things about performance and value.
Yeah, it's a good exercise, applying that focused attention, whether you're trying to understand people or dense financial statements.
Okay, let's jump in. First source. This guide, packed with over 60 podcast questions. Seriously, if you're thinking about doing interviews or even just trying to organize your own thoughts on something, this is pretty useful. It really shows the practical side of having good prompts ready.
And what's really interesting is the structure. It's not just a random list. It groups them into categories, which helps you focus, like personal growth and motivation. You get questions like, what inspired you to start your journey? Or how do you handle failure? These really get beyond the surface, into resilience, what drives someone.
Yeah, and it digs deeper too. For business and entrepreneurship, it asks things like, how do you spot market opportunities?
Mm-hmm.
Or what are the biggest mistakes entrepreneurs make? That's gold for anyone in business. It's like getting straight to the hard-won lessons.
Absolutely. Then there's investing in finance. Questions like, what's your investment philosophy? Or maybe, what advice for beginners? Trying to uncover the why behind financial moves, not just the what.
I like that it covers creativity and innovation too.
Uh-huh.
Things like, where do you find inspiration? Or how do you beat creative blocks?
Ah,
That applies to almost everyone, right? Not just artists.
yeah.
Problem solvers. And then it broadens out to lifestyle and mindset habits, self-care, learning, asking about mindfulness, or maintaining a growth mindset. It's pretty holistic.
Mm-hmm. And to make it human, there's a fun and lighthearted bit. What's a fun fact most people don't know about you? Or the classic dinner with any historical figure
Hmm.
helps reveal the person behind the professional mask. It's not just what they do, but who they are.
So, okay, what does this guide really tell you, the listener? It's more than just a list of questions, right? It shows that good interviewing, or even just good questioning, isn't just about facts. It's about building a path to understanding motivations, values. It's kind of a blueprint for getting authentic stories, not just simple answers. Having this kind of structure is definitely a shortcut to better conversations, helps you frame things, understand different sides of someone's life. It touches on so much.
Yeah, it encourages a much broader view, moving past just the surface stuff to get at what really drives people, their challenges, their goals, getting to the why.
Okay, so we've seen how structured questions can illuminate the human side. Now, let's switch gears completely and apply that same deep dive mindset to something very different. The 2000 shareholder letter from Wesco Financial Corporation. It's dense, but really insightful. From individual stories to corporate numbers, the principles for finding value are actually pretty similar.
Right. So starting with the big numbers for 2000, Wesco's consolidated net operating income. That's key jumped quite a bit. It went to about $70 million or 9.84 cents per share. That was up from roughly $47 million or 6.58 per share in 99. But here's the kicker. Consolidated net income. That absolutely skyrocketed to $922 million. That's 129.56 per share. Compare that to $54 million or $7.60 per share the year before. It's a massive jump.
Wow, yeah, nearly $1 billion in net income. That's staggering. Where did that huge leap come from? Let's break down the subsidiaries. First up, WesFi. That's Wesco Financial Insurance Company, mainly reinsurance, right?
Exactly. And interestingly, WesF actually had a small pre-tax underwriting loss in 2000, about $600,000. That was a change from a gain of over $4 million in 1999, but, and this is important, that was swamped by their net investment income, over $53 million pre-tax in 2000. A big part of that is the benefit from float. You know, the premiums they collect up front and invest before paying claims.
Ah, the float, like an interest-free loan they get to play with.
Yeah, precisely. And they also had some favorable developments from an old reinsurance deal with Fireman's Fund that ended back in '89.
And they were doing supercat reinsurance, too. Sounds intense. The letter mentions they hadn't had any losses from it yet, but it also gave that stark warning.
That quote, recent marginless underwriting results are sure to be followed, sometime, by one or more horrible underwriting losses. That's pretty blunt. Shows the inherent risk in that business, even if things look good short term.
Yeah, no kidding. It's a reminder that big risks can bring big rewards, but also big potential downsides.
Definitely. And another key point for Wes Heftick, very low operating costs. Thanks to deals with other Berkshire Hathaway companies, efficiency was a big factor.
Okay, so Wesco had some underwriting ups and downs, but strong investment income. Then there's KBS, the Kansas Bankers Surety Company, more specialized.
Much more. Wes Evis owns KBS, bought it in '96 for about $80 million cash. KBS focuses on insurance for Midwestern banks, mostly smaller community banks across, I think, 25 states. They offer things like deposit guarantee bonds insuring deposits above the FDIC limits, and director and officer policies. Very niche.
And the letter said KBS started keeping more of its own business in '98, reinsuring less.
Yeah, they went from reinsuring almost half their business to only about 5%. The letter notes this leads to more irregularity in income, basically more volatility.
Makes sense. Higher potential reward, but also higher risk if things go wrong. How do they actually do?
Their combined ratio was excellent, 73.9% in 2000, and even better, 59.4% in 1999. Remember, under 100% is profitable for an insurer's core business. Those numbers are exceptionally good, indicates they were running that niche very profitably.
Okay, got it. Next, a big move. Court Business Services Corporation, bought in Feb 2000.
Yep, a major acquisition. $386 million in cash, plus they took on about $45 million in debt Court already had. Court is the leader in rent-to-rent furniture. So people renting furniture short-term, not planning to buy it, think temporary assignments, staging homes, that sort of thing. And the letter makes this comparison, like Hertz selling used cars. Court is really good at selling its used furniture when it comes off rent.
And its contribution was pretty solid right away, even though they only owned it 10 months in 2000.
Yeah, it added $29 million to Wesco's consolidated operating income for those 10 months. Its pre-tax operating income for the full year 2000 was around $54 million. But just as important, maybe more strategically, was the scale change.
Right. The employee count jumped from, 275 to about 3,000? That's a totally different company operationally.
Exactly, a huge shift. The letter did mention new business slowed late 2000, early 2001, but they still expected Court to stay profitable even if a recession hit. Suggests a resilient model.
Okay, last subsidiary mentioned. Precision Steel Warehouse near Chicago. How do they fit in?
Precision Steel's contribution was smaller, and it went down in 2000, about $1.3 million to operating earnings, down from $2.5 million in '99, so roughly halved. Part of that was LIFO accounting. Last in, first out.
The accounting method. So when raw material costs rise, like they did for steel.
Exactly. LIFO makes your reported costs higher, so earnings look lower. It cost them about $400,000 on the bottom line. They also sold slightly less product, about 3% fewer pounds, and competition kept prices down even as their own costs for steel went up. The letter didn't mince words, called the U.S. steel business in 2000 a disaster.
Okay, so a tougher year for Precision Steel. Now let's loop back to that enormous net income figure, $922 million. You said it was mostly realized securities gains.
That's right. The lion's share, $852.4 million after tax, came from selling Freddie Mac common stock.
Freddie Mac, wow. And there was a story behind that stock, right?
Yeah, a big one. Wesco carried it on the books at the end of '99, valued at $1.4 billion. But it was originally bought by Mutual Savings, which Wesco later acquired for only $72 million. Way back when, only savings and loans could own it. So a massive appreciation over time.
Okay, but here's the part that's maybe counterintuitive. The letter says selling it had a very minor impact on shareholder equity. How does that work?
Yeah, it sounds strange, right? Selling something for a huge gain having minor impact, it's because most of that gain, that $1.4 billion market value minus the $72 million cost, was already reflected in their shareholder equity. It was sitting there as an unrealized gain.
Ah, okay. So it was already counted in their net worth, just not as cash yet.
Exactly. When they sold it, that value just moved from the unrealized gains part of equity into retained earnings. The total equity didn't change much at that moment. It just changed categories. Think of owning a stock that's gone way way up. Your
Yeah.
wealth is higher on paper. Selling it just turns that paper gain into cash. Your actual net worth doesn't suddenly leap the moment you sell.
Got it. That makes sense. It's about understanding the difference between realizing a gain and creating new value.
Right. And selling it also meant paying taxes. The letter mentions this interest-free loan from the government, which is just the deferred taxes they owed on those unrealized gains. That loan dropped significantly from $705 million down to $258 million because they paid the tax man after selling. It's a really transparent way of explaining how these big gains work on the books versus in reality.
Okay, that clarity is helpful. But maybe the most striking thing in this whole letter is that comparison to Berkshire Hathaway. That's incredibly candid.
It really is. You just don't see this often. The chairman flat out states, business and human quality in place at Wesco continues to be not nearly as good as that in place at Berkshire Hathaway. He even pushes back against the idea that Wesco is just a smaller, maybe nimbler version of Berkshire, saying it's not an equally good but smaller version, better because its small size makes growth easier.
Wow, that's humbling and incredibly direct for shareholder communication. He concludes that each dollar of book value at Wesco continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway. And as the quality gap has actually widened, it feels like a lesson in looking beyond just the reported numbers, especially those huge gains, and focusing on fundamental intrinsic quality.
Absolutely. It's a masterclass in focusing on intrinsic value. Very honest self-assessment. Looking forward, the letter said Wesco needed more good investment opportunities, ideally buying whole companies like Court or finding good marketable securities. And they did nudge the dividend up slightly, from 30.5 cents to 31.5 cents per share. A small signal.
So we've journeyed through two very different landscapes you brought us today. First, the art and structure of asking questions to understand people. Then the nuts and bolts and surprising candor of a corporate financial report from 2000.
Yeah, and what it really highlights, I think, is that you can pull out valuable insights from almost anywhere, whether it's broad human experience or technical finance. Applying that focused attention lets you see the underlying structures, the real story.
Exactly. So here's something to think about as we wrap up. How does that intense financial detail, and especially that brutally honest self-assessment in the Wesco letter, change how you think about corporate transparency? Especially when you contrast it with the interview guide, which is all about eliciting insights, personal and business ones. What does it tell you about the different ways we measure success or understanding, and how we choose to communicate those measures? Definitely something to chew on.